Welcome back friends to the class number 95, and now that we have understood the all core concepts of post-shipment finance, now let's come to basic features of this post-shipment finance facility. So let's first discuss the security required in this facility. So in the previous video you have learned about the foreign bill discounting concept and foreign bill negotiation concept. So if your post-shipment finance facility is backed by LC, and if it is not backed by LC, which would mean that it is bill discounting facility. So if it is without LC, then security, collateral security will be required mandatorily. Land and building, whatever the factory, residential property or commercial property have to be mortgaged with the bankers by the borrower, right? But if your post-shipment finance facility is backed by letter of credit, right? You have taken the letter of credit from the foreign party. Now, there are two scenarios. The first scenario is the LC is confirmed LC. The second scenario is LC is unconfirmed LC. Confirmed LC means the foreign banker, like in the previous video we have discussed, this is America, India. The foreign banker, the Bank of America, has given its confirmation on the LC and has accepted the LC which would mean that Bank of America is saying that all the terms of LCs are now complied, and now that I have issued that LC, now I am bound to make the payment to the other party, which the beneficiary, we call him beneficiary, to whom the LC was issued. So confirmed LC, Bank of America is now guaranteeing the payment, so no security is required. Why would bank ask for any security here? Because LC in itself serves as a security for the loan, right? Since the payment is bound to come from Bank of America, right? But the LC, if the LC is unconfirmed LC, Bank of America hasn't given any acceptance on the LC, and borrower is requesting you to finance that LC, to discount that LC, which is not yet confirmed by Bank of America. Then in that case, the risk is there that in future maybe Bank of America may raise some objections or may not confirm the LC. So in that scenario, in order to cover that risk, bank will ask for collateral security from the borrower, right? So that was collateral security that we have discussed here. Collateral security, which would mean land and building or FD, whatever the bankers are accepting, right? But primary security means the asset that is created out of that loan that you have taken. The loan you are taking, post-shipment finance, is used for financing the debtors that are your current assets, right? So charge over current assets is mandatory in all the above three cases. Whichever the case you are doing, in all the three cases, the charge over the current assets will be taken by the banks, but the collateral security will be required only in these two cases. Only in these two cases. In this case, collateral security will not be required, right? Now, margin percentage. Generally, the margin varies from 10% to 25%. Margin means how much promoter need to contribute, right? So if the export bill is of $100, and you are asking your banker to discount that export bill, right, whether backed by LC or not, right? So bankers will not give you total $100. So bank will ask you to contribute your margin as well. So suppose your margin percentage is 10%, so bank will only give you $90 in your account by converting into Indian rupees, of course, $90 into your account, right? So promoter margin requirement is always there here. So the promoter margin varies from 10 to 25%. Generally, it is 15% or 15% range, right? So if the margin is 10%, then 90% amount is credited into your account as a loan by the bankers. So what are the other points? The stock statement is not applicable in post-shipment finance facility, but if you have taken CC limit and post-shipment finance facility as well, then due to CC limit already being there in your loan structure, you have to submit the stock statement. But if you are taking any standalone post-shipment finance facility, then stock statement are not applicable in your business, right? Now, drawing power. Like I have explained to you in the previous videos of overdraft, right? So drawing power has indirect impact here. Practically speaking, if you have taken any post-shipment finance facility, standalone post-shipment finance facility, then there is no requirement of drawing power, there is no requirement of stock statement, and many banks even waive your stock audit as well, right? Except one or two banks, right? So none of these requirements are applicable. But if you have taken CC along with post-shipment finance facility, the CC can be from your existing banker and CC can be from other bankers as well, right? Then the post-shipment finance facility will impact your drawing power in an indirect way, right? Why would it impact your drawing power? While when you have taken the CC, you submit the stock statement. In your stock statement, you declare your stock, you declare your debtors, you declare your creditors, right? So suppose you are declaring the debtors on total basis in your stock statement, right? But part of those debtors are financed by the bankers in terms of post-shipment finance facility, right? So if you are providing total debtors figure to your CC financer banker, so in that case, that banker will adjust your post-shipment finance facility also in drawing power calculation. You have two options: either to show all the debtors and you have to then take the impact of post-shipment finance facility as well in your drawing power, or the second option is you can choose not to show the debtors at all, right? Which are discounted from post-shipment finance facility, so you show only net of debtors. So if you are showing only net of debtors for CC drawing power, then there will be no additional impact considered for post-shipment finance facility, right? If you are confused about this point, then let me know in the comment box. I will make a separate video about that. What is the maximum tenure? The tenure is based on your debtor cycle only. Normally, bankers allow you 90 days up to maximum 90 days, but can go up to 180 days as well. But it is practically based on your debtor cycle. How repayment is done? The repayment of this facility is done from your export proceeds. Whatever payment your foreign party, David, in our examples, is making to you, that payment will be adjusted to knock off the dues of post-shipment finance facility. But in the next video, we will discuss about the repayment of pre-shipment and post-shipment finance in a bit of more detail, right? But generally speaking, export proceeds will be used to knock off your dues. So annual renewal is applicable in this facility. You have to renew this facility every year, even though the facility, you see, there are two types of thing. One is the validity of the facility. The facility is valid for 12 months period, right? And one is the tenure of the facility. Tenure is based on your debtor cycle, based on your working capital net debtor cycle. So renewal is annual because the validity of this facility is 12 months only. So comfort level of the banks are, I have worked in banks in credit profiles for 10 years. So let me say it once again: bankers are highly comfortable in funding the post-shipment finance facility to the clients, even better than CC limit or pre-shipment finance facility. Why? Because in post-shipment finance facility, finance is given once the exports are done, right? You have submitted your export proof, you have submitted your documents to the bankers. After getting full confirmation on your export, only then financing is given to you, right? So end use is 100% clear. There is no chance of diversion of funds here, right? So the comfort level of bankers is very high in sanctioning of this facility. How this facility is assessed? This facility is assessed on MPBF basis. Plus, you have to assess it on individual cycle calculations as well. So MPBF, I have already explained to you that individual cycle calculation that I will explain to you in next Saturday's video. So tracking, how this facility is tracked? This facility is generally tracked on order basis only. Each and every export bill you have taken discounting from the bank is tracked separately for its payment. It's generally not like running limits like CC or packing credit, pre-shipment packing credit. It is tracked on order basis only. So how this facility is disbursed? You have to submit the export proof, export documents set to the bankers, and basis that proof and after taking the acceptance, the banks will disburse the facility amount to you, right? So in next lecture, in the lecture number 96, class number 96, we will discuss about the repayment of pre-shipment and post-shipment finance facility. Thank you for watching this channel.